You're listening to Angel Insights, brought to you by SyndicateRoom. This is the show that delves inside the world of angel and early stage investing to discover their tips, tactics, and process when it comes to investing. And today I'm delighted to be joined by Ben Wiener, managing partner at Jumpspeed Ventures, self-proclaimed to have raised one of the smallest first funds ever, with a first fund of around $255,000. However, due to the immense success of Ben's thesis and investments, he has gone on to raise a further fund which is 10 times the size of his first one, so a huge congratulations to Ben on that. And today is a super interesting interview with Ben in revealing the benefits of having a very tailored and niche approach to investing and choosing one particular segment of the market and nailing it. And Ben has clearly done that with Jumpspeed. And do not forget to check out the site at www.syndicateroom.com, where you can read the accompanying article from our episode with Ben. But now, without further ado, it gives me great pleasure to welcome Ben Wiener, managing partner at Jumpspeed Ventures. Ben, welcome to Angel Insights. It's an absolute pleasure to have you joining us today. Thank you so much.
Thanks for having me. I've been listening to all of your shows for a long time, and it's a privilege to be on.
Now, I'd love to kick off the show today by hearing a little background about you and tell us how you made your entry into the investing world and as you said in a previous email, why the heck you're doing what you're doing.
Yeah, it kind of smacked me in the face. I did not intend to be an investor when I grew up. I started off my career, I grew up in the United States. I started off my career as a corporate lawyer, graduated from Columbia Law School in New York. And after law school, the year after law school, was accepted to be a law clerk on the Israeli Supreme Court. And my wife and I had wanted to sort of try living in Israel. We had dreams of one day maybe moving to Israel. So it was sort of an idyllic year, almost 20 years ago, clerking on the Israeli Supreme Court. And during that year on the ground in Jerusalem at the court, integrated a little bit networked into the technology scene that was really in full development at that time. And we decided that we wanted to get back to Israel as soon as we could. So went back to New York, practiced as a young associate at a big law firm. And then we moved to Israel permanently in 1998. My dream had been to sort of do corporate law for a little bit and become a deal maker and get into business development or corporate development. And that's exactly what I did. So about a year after moving to Israel in 1999, almost 17 years ago, co-founded my first software startup here in Jerusalem. And I've been on the business development and corporate development side ever since, working in a bunch of small companies and one big publicly traded company, doing business development and some M&A and corporate development. And I just assumed that that's what I would do for the rest of my life. I loved it, and I loved building things and doing deals, and I thought that's what I would do for the rest of my life. From about the bubble bursting around 2002, for almost over a decade, till about 2012, the Jerusalem startup scene had pretty much evaporated. And everything you sort of hear about Israel becoming a technology power, almost all of that was happening outside of Jerusalem, in the center of the country, Tel Aviv, and those kind of central cities. In about 2012, after about a decade of very little startup activity in Jerusalem, I was working on a couple of startup companies and basically was invited to go to a pitch night. I guess the epiphany or the vignette that really crystallized this whole thing. I was invited to pitch to a startup pitch night at a bar in Jerusalem in about late 2012 on Facebook. And that was something that I had never seen before, like a pitch night in Jerusalem. I go to the bar. I'm about 43 years old at the time. Everybody else in the bar is like 21, 20, 19 years old. And they're passing around a microphone in the back of the bar with a little speaker, and everyone's pitching their startup company. So I'm online, and I'm deciding which one of my startup companies that I'm working on I'm going to pitch. And I say to the guy next to me, "Who are we pitching?" And he says, "Well, what do you mean?" I said, "Well, where are the investors?" And he laughs in my face and says, "What? This is Jerusalem. There are no early stage investors in Jerusalem. We're pitching ourselves." And I said, that's crazy. Like, we're in the capital of the startup nation at the peak of the boom, 2012, 2013, and there are no early stage investors to pitch, and we're just sitting in the back of a room pitching ourselves. And I said, somebody could come in here and with a little bit of money make a big impact and be that like early stage investor. And then I said, maybe I'll do it. So I raised what was probably at the time, and still it probably is, the smallest venture capital fund that's ever been formed in the history of the world.
Are you allowed to say how small it was?
I'm allowed to say how small it was because it's gotten bigger, but I opened up Jumpspeed Ventures with $251,000 in a Silicon Valley bank account. And I didn't say a word to anybody until I had the money in the account. I had a couple of LPs that were crazy enough to believe in my thesis, and I branded the fund only around the ecosystem of Jerusalem. I said, I'm going to invest only in early stage software companies in this city because that's where I felt the opportunity was. And I felt that branding would propel me or get momentum for the fund and gain sort of a following and attention. I didn't even realize how true that was, but that was my basic thesis. And I opened up my office, and I was literally blown away and bowled over with deal flow from the first minute.
And how much then was the average check size?
I started off, and I still will generally enter a company with generally the first money into a company with about $50,000 to $100,000 as an initial investment. Mm-hmm. As I said, I've been able to grow the fund size, so I actually have the ability to follow on after that into specific opportunities that are growing. But my initial check is going to be anywhere from about 50 to 100. That's going to be my sweet spot. And that's obviously not enough to carry a company, but it's going to get a company started and get it on its feet. And it's amazing what we've been able to do at Jumpspeed with that kind of investment. We've been able to take some companies from inception to actually to revenue with $50,000 or $75,000. So the money goes a lot further here than in other parts of the world.
And you mentioned there two very specialist filters in terms of your hyper Jerusalem focused and hyper early. So let's break this down. Why did you decide to be so location focused? And how do you feel the ecosystem is now?
Well, I'll start with the second one. When I started investing, we sort of did a quick census. And when I say we, there's something very unusual about the Jerusalem ecosystem in that there, at the time, late 2012, early 2013, there was a little bit of a leadership developing, a young leadership of the startup ecosystem. There were about 5 or 6 individuals in different jobs that just voluntarily were coordinating all the activity among this young, resurgent, vibrant, technology startup scene. And together we sort of did a census of how many companies we could count. And we counted at the end of 2012 about 100 active startup companies. That number has now grown to between 400 and 500 that we know of in the last 3 years. We knew that in 2012, those companies raised about $50 million in venture capital. We know that in 2014, 2015, Jerusalem companies have raised between $250 and maybe $300 million per year in venture capital. So the scene is blossoming nicely. And again, in terms of your first question, why I got into that, I was responding to an opportunity. I wasn't seeking to become an investor. I was seeking to answer a need. And like a typical startup, the product market fit for me, for Jumpspeed, was going where there was a non-competitive environment, where I had a competitive advantage. I did not feel that I as a new entrant, had a competitive advantage looking at Tel Aviv-based startup companies where there were deeply entrenched early-stage investors that were completely swamped with that deal flow. I felt that anything I would see from that part of the country, I would by definition be last in line. But the flip of it was in Jerusalem, since those investors, again, for historical reasons, were generally not looking for opportunities here, I could have a distinct advantage. And the momentum of branding myself around a specific ecosystem would get me a very quick reputation, very quick, heavy deal flow without self-promoting, without making a lot of noise, which is my nature. And that has played out to be completely true. In fact, if you look at my website at jumpspeed.co, you'll see the mayor of the city, Nir Barkat, who himself is a former venture capitalist, doing a promo for my fund. And what venture capital fund gets the mayor of the city to do a video promo? You get to do that when you're the only one doing it. And I've been, I've sort of benefited from that uniqueness.
So benefiting from that uniqueness and having discussed then the massive growth in VC funding from, I think you said 50 to 250 million, if startups aren't getting funded by you in the very, very early stages, what are their funding options?
I can't claim to be the only one. There are very, very few of us that are looking. And first of all, $250 million a year is still pretty small. So I would still consider ourselves a small ecosystem. We have been ranked in the top 30. The Jerusalem ecosystem has been ranked as one of the top 30 largest tech hubs in the world by Startup Compass last year. But even so, it's still kind of small. And we have definitely attracted a lot more attention. There are more investors coming in and entering the market every day. I still have about a 2-year head start on them, so I'm happy to see new people coming in and we co-invest alongside each other. So there are new entrants. There's a little bit of crowdfunding that's creeping into the market. Our crowd, which is a dominant crowdfunding hub, is headquartered in Jerusalem. So, startup founders technically have access to that kind of network if they want to and if they can get in. So there are other opportunities, but still, the vast majority of them are still struggling to raise capital, and I'm extremely picky, so I'm not, Jumpspeed's not going to be the comprehensive answer to this entire ecosystem's early stage funding needs.
And as you are so super early, what do you then look for in the companies? I mean, at this stage, there's rarely any metrics or KPIs to go on at all. So
Right.
What are the determinants for you?
I believe that I've tried to make this as formulaic as possible. So I've developed a sweet spot methodology for myself. Since I'm the sole decision maker at Jumpspeed. Jumpspeed is me. So I have to make a very refined, almost disciplined, formulaic analysis of opportunities as they come in. So I go through a series of checkdowns as I see new opportunities and meet new entrepreneurs. And I think that sweet spot methodology has worked really well for me. So what I'm saying to a company is, or to a founder is, often and I'm saying no 99% of the time, when I'm saying no, it's usually not, no, I don't think this is going to work. It's just, no, it's not right for me. In my check down, I'm looking first and foremost at the product, and I'm looking for extreme product market fit from this idea. And that means, software only, because of the amount of capital I'm deploying, I can't get involved in hardware or biomed in any way. I don't really have a lot of value or experience or domain expertise in those areas. So I'm looking for software only, a company that's born or based in the Jerusalem ecosystem. Within that, I look for acute pain, and that generally leads me more to B2B than B2C. I'm looking for, acute pain, like aspirins versus vitamins. I'm looking for things where there's a current pressing pain point in a given identifiable market, and where that pain occurs with frequency and or density, or preferably both. Those are terms that I learned from a great blog post by Manu Kumar out in California. So pain with frequency and density, and where the flip side of that pain is that current solutions are inadequate. Not just suboptimal, but grossly inadequate. And it's really rare to find an acute pressing current pain that somebody in this massive world hasn't figured out how to solve in some way or another. So that already filters out like most of the things that I see. And if I see something that has acute pain, currently faced with frequency and or density or both, where current solutions are inadequate, then I have to believe that the person standing in front of me or the people standing in front of me have the ability to execute a paradigm shift and some solution that's going to solve that pain. And then, which already filters like almost everything, then the last two checkdowns are, is it something that I can get passionate about personally and help with personally? Does this startup give me goosebumps when I talk about it, which is true for every one of the companies I've invested in? Finally, are the people or the person somebody that I want to hang out with and partner with for the next 5, 6, 7 years through ups and downs, through good times and bad times? Do I want to have these people over at my house and meet my wife and kids, which in most cases I've done? And if I can't pass all those tests, then I'm more than happy to shake their hand and say, thank you very much. I wish you the best of luck, and wait for the next one to come in. And I do see things, believe it or not, that meet all of those criteria about 3 or 4 times a year, and those are the investments that I make.
And of those companies then that we mentioned just now, 4 are actually, of the 9 portfolio companies you have, 4 are actually produced in-house by you and your team. Am I right?
Yeah, I've sort of modeled Jumpspeed after Betaworks in New York. I really admire what they've done, and I think it's again, sometimes you meet entrepreneurs. Once I'm deeply entrenched in this ecosystem, so I meet a lot of people, and sometimes you'll meet a very talented entrepreneur who doesn't not necessarily attached to a specific idea, and you'd say, "I'd love to work with this person," but they don't have a startup yet. So I keep tabs on those people, and every once in a while, I mean, it happens very rarely, but every once in a while, it's happened 4 times over the last 2.5, 3 years. I'll have an idea, or a conversation will come up based on things that we're seeing in the marketplace, and we'll say, "Hey, we could start a startup around this thesis. I've got the money in the fund to be able to seed the company. I'm not going to be able to run the company, but I've met a fantastic entrepreneur who's dynamic, who's looking for a new opportunity." And we've done that about 4 times over the last couple of years. And I'm committed to continuing to do that. The economics are fantastic. The opportunities are things that, by definition, I'm extremely passionate about, and I've generally researched pretty carefully. So it's a win-win for everybody. It's definitely a win-win for my LPs in the fund, and it's an exciting sort of realization of what this ecosystem can produce.
And then working at such an early stage that, as we said, sometimes not even company formation has happened. You work with angel groups closely then in Jerusalem, I presume. So what's the angel ecosystem like?
Well, sadly, and I guess the rationale for starting Jumpspeed in the first place was that there really wasn't a very good ecosystem in Jerusalem. So what that requires is that I can't really rely on too many other local investors to co-invest with Jumpspeed when I've taken the bet on a company. And I have to have relationships lined up outside of Jerusalem, not just in Israel in general, but also in other countries, particularly the U.S. where I come from. And I have to really believe that after I write that first check of 50 or 100K, almost immediately we have to go to work raising or generating additional capital from co-investors that may be far away. So I spend about 20% or 25% of my time networking and developing relationships by necessity among other investors that get to know Jumpspeed and that I get to know, that I'd like to work with. And I've been successful a couple times at bringing in co-investors into Jumpspeed portfolio companies who are not within the Jerusalem ecosystem, just because the Jerusalem funding ecosystem is still not adequate. It's not well developed.
And how important then do you think it is for investors to be close to their portfolio companies?
It's a little bit of a conundrum. I mean, you don't want to, as an investor, you don't want the company to be reliant on you. I mean, the notion of being a hands-on investor, which a lot of VCs like to brag about, can be a blessing and a curse. And I've experienced this. If you develop a company and as an investor, you're too hands-on, well, it might mean that there's some deficiency in the founder because they're not self-sufficient, and it might mean that they become too dependent on you too quickly. So you do, I think, as an investor, want to be helpful when you can and when you need to be, but also believe that your companies are or can quickly become as self-sustaining and self-sufficient as they can, because they have to be built for a very long ride. So it is definitely a balance, and I think each company is different, but I don't think there's an absolute value in investors being too hands-on. And I've found, while I do spend about 40 to 50% of my time inside certain companies, it's generally the companies that need the help, which is often not a great sign. And you tend to gravitate towards the ones that are lagging or the ones that need additional assistance. And it's not necessarily great for anybody if the investor is too closely involved.
And talking of companies that maybe need additional assistance, can you tell us about a war story, a company that's gone a little wrong, and give us a little detail on the investment and what went wrong and how it changed your style as a result? Obviously, no names needed.
Yeah, I can say that I have, of the 9 companies in the portfolio, I have not written anything off yet. There are definitely a couple that are taking off like rocket ships, and there are a couple that are further behind. And the one in particular that I'm spending a lot of time on, I think, I don't know if it's a war story, but I think what I didn't know at the beginning or was not fully aware of, and what I learned later on, was the importance of speed of development. I did not believe, I'm not an engineer, and I think as a non-engineer, I tend to just take whatever the developers are telling me as gospel. And I think I didn't understand how much control or how much impact I could have as an investor in the actual development process of these companies. So I had, let's say, one company where I don't want to say it was held hostage, but kind of developing at a slow pace. And I learned later on during, let's say, last year, my second year of investing, that I could have more of an impact on that process through different methodologies of management. So I think the notion of speed is something that I did not understand fully, or my ability to control speed and pace, where I now have a better understanding, and it's starting to play out in some of the newer companies.
And if it's okay with you, I'd love to dive into a quick fire round now.
Yeah, I've been dreading this, having listened to your podcast, but I'm ready.
I don't know why people dread it. This is the fun part.
Exactly. No, go ahead.
Okay, so favourite book and why?
Yeah, I think I keep a book on my shelf that's a little interesting. It's called The European Discovery of America by Samuel Eliot Morison. It's an old book, and if you think that entrepreneurs are nuts today, think about getting into a wooden ship and trying to find another world. I think it's very similar to venture capital in that the technology of the time were wooden ships and the Pythagorean theorem, and the VCs were kings and queens, and the burn rate was literally like life and death, and often resulted in actual death if you miscalculated food and supplies. So there's a lot of metaphors in that book. And it's extremely well written, and you kind of feel like you're on the ship with John Cabot looking for North America. But there are a lot of metaphors in there for the current entrepreneurial journey that I find that resonate. That's an old book. And in terms of the typical VC books, the one book that I give all my companies is the Traction book by, I think, Gabriel Weinberg.
Absolutely.
It's a fantastic book, and it gives a methodology for defining the 19 channels of commercial traction, which all of us read and passed around within the portfolio.
And if you could give founders one piece of advice, what would it be?
This is going to be a little strange. I think my advice, which I tell my founders a lot, is embrace schizophrenia. I think that there's a schizophrenia that pervades the entrepreneurial journey, and it's great. I think you have to understand that you have to balance at all times extreme confidence and extreme panic. And that's fine. That's totally normal. And that feeling of like both sides of your brain pulling in different directions, like when you drink a Red Bull with vodka, that's what the entrepreneurial journey is like. That's fine.
And then your favorite startup or investing blog or newsletter?
Yeah, so I read, because I don't think that I'm very smart, I force myself to read about an hour or two a day. And there are I probably have 10 or 12 blogs and newsletters that I'm reading regularly every single morning. So obviously the main ones like Mattermark Daily and CB Insights is fantastic. Those are key sources of information for me, but I'm going to throw a couple at you that you may not have heard of or that your readers may not know.
Fantastic.
That I find
I'd love to.
They're unbelievable. So one of them is Jerry Newman from New Venture Partners, New Venture Capital in New York. His writing is incredible. I encourage everybody to read. Unfortunately, he doesn't blog that often, but he's amazing. Leo Polovets out in the Valley. Every time he writes, it's spot on, and I'm a huge fan of his writing for early stage investing. And in your neck of the woods, anybody doing anything in mobile, there's a newsletter out of, I think, London called Mobile Fix by Simon Andrews that it comes out every Friday. And Simon has his finger on the pulse of everything going on in mobile, and I've learned tremendously every week from everything that he writes.
That's awesome. Fantastic. 3 new blogs for me to read.
Yep.
And then the founder you most respect or admire?
Yeah, so I don't personally know a lot of the superstar founders that everybody quotes. The one I'm going to pick for you is one right here in our ecosystem in Jerusalem, Bob Rosenshine. I think Bob, who co-founded and exited so far 2 successful Jerusalem-based software companies, is really the epitome of what this ecosystem has to offer. I'm proud to have invested in his latest startup company, so his new one, Curio, is part of the Jumpspeed portfolio. And anybody who's ever met Bob knows that he's just the epitome of the nicest guy in the world, the classiest person, always has a kind word and is always approachable, and yet extremely smart and extremely talented at the pivot and navigating markets with his companies. So for him, he's always been a mentor of mine. I'm privileged to now be an investor of his, and I think he symbolizes what the Jerusalem ecosystem can produce and has to offer.
And then the vision for Jumpspeed. What's the plan for the next 5 years?
Stay the course, just get bigger and keep investing. I wouldn't change a thing in terms of my sweet spot or my methodology, my pace. I think, investing 3-4 times a year is perfect. Being extremely picky, seeing a couple hundred deals a year, picking the few that are right for Jumpspeed that I want to ride with for the next couple of years. And I hope that I'll have the ability, Jumpspeed is still very much a startup. My fund, I tell my founders that my fund is a startup, just like their startups are startups. And I think I've proven the proof of concept and now hit product market fit. And I think now the goal is to develop it into something bigger that's built for the long term of investing in the ecosystem in Jerusalem for years to come.
And then finally, your most recent investment and why you said yes.
I think technically my most recent investment is a company called Exigence. This is my first enterprise class software play. It's a cloud crisis management platform. And why I said yes is, I'm a big student of Steve Blank and, the sort of lean startup, get out of the office methodology. And what I love about Noam, who's the CEO of Exigence, he's a first-time founder. He had this idea, and he said to himself, I don't know if this idea has legs. I'm going to go out and talk to a bunch of, potential customers and see if they need this. And 9 out of the first 10 enterprises that he approached said, yeah, this problem exists. We've been looking for a solution. There's no adequate solution. I'm the decision maker. I would buy this if you had this ready. Call me back as soon as it's ready. I'm ready to spend money on it. So I think it doesn't get any better than that. And that's when I leaned forward in my chair and and started to dig a little deeper into him and into the opportunity.
Well, Ben, thank you so much for coming on the show. It's been an absolute pleasure chatting to you today.
Thanks for having me. This is a great milestone in the early part of my career, and I'm really happy to have been on the show.
How fantastic to hear Ben's investing thesis and strategy in the hyperlocal market of Jerusalem. And if you'd like to read the article from today, then you can find it at www.syndicateroom.com, and you can follow us on Twitter at SyndicateRoom. We'd also like to remind you that early stage investing is risky, therefore please ensure that you engage in the proper due diligence prior to making the investments. Thank you so much, as always, for your continued support, and we look so forward to bringing you next week's episode.